All right, today we are tackling one of the most important and, let's be honest, often intimidating documents out there, the IPO prospectus. We're going to break down what a company is offering, why they're doing it, and what it all really means for you as a potential investor. And we'll be using a real-world example to guide us through it all. I mean, it's a pretty tempting thought, right? The idea of getting in on the ground floor just as a company makes its big public debut. Well, that's exactly what an initial public offering, or IPO, is all about. But, before you can jump in and play the game, you got to understand the rulebook.
So think of it like this. An IPO is basically the bridge a company crosses to go from being private to being publicly traded on a stock exchange. They're selling off little slices of ownership, we call them shares, to raise money. And in return, those shares can be bought and sold by you, me, and pretty much anyone in the general public. So, to get our heads around this, here's our game plan. First up, we'll meet our case study for today, JF Packaging. Then we'll dive straight into the numbers of their IPO. After that, we'll read the fine print, the risks. Then we'll cover the practical stuff, how to participate, and finally, we'll zoom out to see the big picture. Let's get into it.
Right. First things first, before you can even think about the deal itself, you have to understand the business. So who exactly is JF Packaging? Well, if you look at their journey, you see a story of really deliberate long-term growth. They were established way back in 1987, so they've been building this for decades. And the last few years show a really clear expansion strategy, with some key acquisitions in 2017 and 2018. They've been getting industry recognition, and they hit a huge financial milestone in 2023, over 1.2 billion Sri Lankan rupees in profit before tax. So this isn't some flash-in-the-pan startup, it's an established player looking to get to the next level.
And what's interesting is that JF Packaging isn't a one-trick pony. Through all those acquisitions, they've built up a really diverse group. I mean, they make everything from flexible food packaging and PET bottles to industrial tapes and even coir products. And this diversification is a big deal, because it spreads their risk across a bunch of different market segments.
Okay, now let's get to the real heart of the prospectus, the numbers. This is where the company lays out exactly what it wants from the public and, just as importantly, what they plan to do with all that cash.
The headline number here is just the sheer scale of this thing. The company is putting almost 52 million new shares up for sale. To give you some perspective, that's going to be about 30% of the entire company after the IPO. So they're not just selling a few shares here and there, they're offering a significant piece of the business to the public.
So, the million-dollar question, or in this case, the 600 million rupee question is, why are they doing this? Well, the prospectus is crystal clear. The goal is to raise over 600 million Sri Lankan rupees. And get this, 100% of that money is specifically earmarked to pay down the company's outstanding debt. This is a huge signal to investors. They aren't raising cash for some risky new venture. They're all about strengthening their financial foundation.
And they give us a super specific breakdown of that debt. It's not just some vague promise. As you can see, about 3/4 of the money is going to settle long-term bank loans, and the rest will pay off shorter-term import loans. This kind of transparency is really designed to build investor confidence.
The strategy here is pretty straightforward. By using the IPO funds to wipe out these loans, the company instantly makes its balance sheet stronger. And that means lower annual interest payments, which, in theory, should boost their profits and create more value for all their new shareholders. Makes sense, right? But as we all know, every investment comes with risk, and the prospectus is legally required to spell out every single one in detail. So this next section, this is the one you really need to pay close attention to.
And this right here, this is a big one. It's a direct quote from the document, and it's a standard but absolutely crucial disclaimer. What it's saying is that the Colombo Stock Exchange, the actual marketplace where the shares will trade, is not double-checking the company's claims. The responsibility is on the company to be truthful and on you, the investor, to do your own homework.
So the prospectus then breaks down the risks into different categories. On one side, you have industry risks. These are things totally outside the company's control, like the price of plastics going up or major supply chain problems. On the other side, you have operational risks. These are the internal challenges, like a key piece of machinery breaking down or labor issues.
And then there are the risks tied directly to the IPO process itself, because there's no guarantee it'll even succeed. If they don't sell enough shares, that's called being undersubscribed, or if they can't attract at least 200 different investors, the whole listing gets canceled and everybody gets their money back. And it's also worth noting, the document says the board can reject any application, which gives them the final say on who their shareholders are.
So, let's say you've read the business plan, you've analyzed the numbers, and you've weighed the risks. What happens next? Let's walk through the practical steps for actually applying for shares.
Okay, the process is basically broken down into 4 key stages. First, and this is an absolute must, you need what's called a Central Depository Systems, or CDS account. It's basically a digital wallet where your shares will live. Second, you submit your application, which you can often do online. Third, you pay for the shares you're asking for. And fourth, you wait. If your application is successful, the shares just get deposited right into your CDS account.
So after all of that, let's just zoom out one last time. Why would a company and an investor go through all this trouble? Well, the prospectus paints a pretty clear picture of the potential upside for everyone involved.
So here's the value proposition the company is offering you. They're arguing that with less debt, they'll have lower interest payments, which should directly translate into higher potential profits. That creates a healthier, more resilient balance sheet. And ultimately, they're saying this IPO creates a stronger foundation, giving them the platform to invest in future growth, which should benefit everyone who holds their shares.
And that really brings us to the final question, doesn't it? A prospectus gives you hundreds of pages of data, financials, and risks, letting you make a calculated decision. But at its core, you're also placing a bet on a company's vision for the future. So, is it more about the numbers on the page, or is it about your belief in the story they tell? Well, that's something every single potential investor has to decide for themselves.